that I think will survive hyperinflation or very high inflation. Even if we don't get Weimar Germany style, Zimbabwe style hyperinflation, we're still going to get, Argentina's type inflation, which wasn't hyper, but it was pretty damn high.
In his latest video, renowned economist and financial commentator Peter Schiff delves into the precarious state of the global economy, emphasizing the looming debt and currency crises. Schiff highlights the role of central banks in fostering an environment of unsustainable debt through artificially low interest rates, leading to an inevitable financial reckoning. As he explores the comparative vulnerabilities of major currencies, he warns of the severe consequences facing the U.S. if the dollar loses its status as the world's reserve currency. Join Schiff as he unpacks the complexities of our current economic predicament and forecasts the potential fallout on a global scale.
Well, I think we're all in a lot of trouble, so it just depends on the degree, and it's all, I guess, relative. If one nation is in even worse shape than another, it doesn't mean that the nation that's in less bad shape is in good shape. And, the reason we have so much debt is because central banks have been so accommodating to the borrowers by keeping interest rates so low. In fact, for many years in Europe, they were paying people to borrow money. Interest rates were negative. And so as a result of artificially low interest rates, governments, households, businesses all took on, far more debt than they could reasonably service in a normal interest rate environment, and debt that they can't repay in any environment. And so we are facing a debt crisis, which will ultimately become a currency crisis. Because what happens when you can't pay your debt is you print money. And when you print money, you destroy the value of the currency. And so that's where we're headed. And as the question is, which currency is going to lose the least or the most in relation to another currency? And it's hard to say. Right now, the yen seems to be the weakest of the major currencies. But I think ultimately the dollar has the most to lose because we're the country that benefits most from the current status where the dollar is the reserve currency in a global fiat system. So we really have an advantage in the United States that allows us to take on a lot more debt without suffering the adverse consequences that other nations would suffer if they were doing what we're doing. But I think that when the dollar's status is lost, then we're particularly vulnerable to a massive crisis where our whole standard of living is going to topple to a much greater degree than what you see in Europe or Japan. I just think that that's the mistake that people conclude. And the only reason we don't look as dirty is because of our reserve status. So if we didn't have that, then it would be obvious how dirty our shirt is.
Yeah.
But, people just haven't figured it out. And if you look at long-term bond yields, the U.S. government is still borrowing for 30 years at below 5%. And so, that doesn't make any sense that we could do that. If and in fact, if you look at the spreads, the tip spreads, bond investors are expecting inflation to average about 2.3 to 2.4% over the next 30 years. There's just no way that that's going to be the case. It should be obvious that over 30 years, inflation will be much higher, if not multiples higher than that. Well, sometimes the markets get it wrong in the short run. I mean, look at how they valued subprime mortgages. They valued them above par until they became worthless. I think they were worthless the whole time. It's just that Wall Street didn't get it. The people that were buying the bonds and paying premiums to par didn't realize that they were going to lose all their money. They didn't understand the dynamics in the real estate market. And I think the same thing is happening in the treasury markets, which are highly influenced, of course, by government intervention. But I don't think bond yields reflect anywhere near what inflation is likely to be. I think a lot of people have been fooled into believing that the Fed or other central banks can keep inflation around 2%. That they can't, not with the massive amounts of deficit spending in their respective governments. lots of money is going to be printed. And that means the inflation rates are going to be much higher. If you go back prior to the 2008 financial crisis, just look at the 40 years from 1968 through 2008, inflation averaged just under 5% for those 40 years. And not once during those 40 years did the Fed ever claim that the target was 2%. At times they, were dealing with the inflation problem, but they never said they had a 2% target. They didn't adopt that target until we were under 2%. And then it served their purpose because it was really a pretense to justify printing more money and artificially propping up asset prices, subsidizing government spending and monetizing government debt. They were able to justify the reckless monetary policy based on the fact that we were below the 2% target and that we needed higher inflation. Well, we needed it like a hole in the head, but now we've got a much bigger hole because inflation is well above 2% and it's never coming back down. I mean, not anytime soon. But the markets haven't come to terms with that reality, that what we experienced, that sub 2% inflation, was an aberration. It's not happening again. I mean, that's part of it, but it doesn't necessarily explain the spread between treasuries and tips because that could widen. I mean, so I think investors are really clueless right now. But in the short run, investors can make mistakes. Look, Peloton shares during the pandemic were up at $170, and now they're $3. Same company. Investors just got it wrong. They made a lot of assumptions during COVID that weren't true. And they're making a lot of assumptions about the Fed and its ability to control inflation that are just not true. And so everything is mispriced. Bonds are overpriced and gold is way underpriced. Gold is priced as if inflation is going to stay close to 2%. It's not. I mean, it's more likely to be 20% than 2%. But, the markets haven't priced that in. And eventually they will. I think over the next year or two, maybe within the next year, more people are going to start to see the truth. And that's going to be reflected in a much higher gold price. Yeah. And back then, too, there were still some people that were holding out hope that Congress was going to get its act together and deal with these issues. But of course, that never happened. And it's not going to happen. Unless there's a crisis, we'll never act preemptively to avoid a crisis because the politics don't make any sense. And so it's not going to happen. But sure, I mean, you look at the interest on the national debt right now, it's over $1 trillion a year. And by the end of next year, it'll be $2 trillion. And so right now it's bigger than national defense as far as what we spend. But by the end of next year, it'll be bigger than either Medicare or Social Security. It'll be the biggest line item in the federal budget. And it's going to keep growing from there exponentially. And, the higher our debt is, we have to borrow the money to pay the interest on the debt. So the more money we have to borrow, if we're paying $2 trillion a year in interest, that $2 trillion needs to be borrowed because we don't have it on top of the trillions that we have to borrow to fund the operating deficit. So it's just spiraling out of control. And so it has to end in either default or massive inflation. Those are the only two ways that this movie ends. And it's a disaster either way, if you're holding dollars, if you're holding any bonds denominated in dollars. But what it's most likely going to look like on an inflationary default, rather than a legitimate, we can't pay, and so we're not going to do it, everybody gets paid in money that's not worth very much, is prices go through the roof and the value of currency collapses. The minute we default on anybody, of course, it's a whole new ball game because now treasuries are no longer risk-free. They never really were risk-free, but people just didn't realize that. But the whole bond market implodes. The dollar, I think, goes down even under that scenario. But we're more likely not to default on anybody because the politicians don't want that because it's too embarrassing. It's obvious that, they're the source of the problem if they're the defaulter. They'll just inflate. They'll just print money and blame the ensuing inflation on greedy corporations, speculators, foreigners. They'll blame it on gold buyers. They'll blame it on people like me for encouraging people to buy gold or buying gold, because we helped drive down the value of the dollar. But it's their policies that drove down the value of the dollar. I'm just advising people to buy gold to protect themselves from an inevitable collapse. What we're doing to protect ourselves is not causing the crisis. It's the crisis that is coming that is causing us to take preemptive actions to preserve our wealth, right? I'm not going to just go like a lamb to the slaughter if I know that that's where we're headed. So I'm going to try to do something. And I do that. I help my clients buy physical gold. I also help them accumulate real assets around the world that I think will survive hyperinflation or very high inflation. Even if we don't get Weimar Germany style, Zimbabwe style hyperinflation, we're still going to get, Argentina's type inflation, which wasn't hyper, but it was pretty damn high.
As Peter Schiff concludes his insightful analysis, it's evident that the world stands on the brink of unprecedented economic challenges. Stay informed by subscribing to the channel for more expert commentary and in-depth discussions on finance, investing, and the global economy. Don't forget to like, share, and hit the notification bell to stay updated on future content. Thank you for watching, and remember to navigate these turbulent times with knowledge and preparation.